Good afternoon, everyone. I'm CA Deepika Agrawal, the moderator of this event. We are delighted to welcome you all to this webinar, which is organized by the Continuing Professional Education Committee of ICAI. Please block your calendars on every Friday to get insights into various emerging and high-value technical topics. It is my pleasure to be the moderator for this webinar on UAE transfer pricing and IBC and valuation. In a short while, we will start this webinar. First, I would like to apprise you about the CPE committee. In today's ever-changing professional scenario worldwide, the biggest challenge the professionals face is how to stay on the top of their game while adapting to new requirements and norms. As AI has already taken over the world with a storm, we professionals should be ready to take up this storm and be aware about the various policies. And already one program has been organized by the CPE committee before this webinar. Therefore, it is imperative to aim and to be up to date to offer unique guidance, influence others with their innovative approach and expertise. It is also vital to stretch old ideas beyond traditional boundaries to create new perspectives. In this context, continuing professional education facilitates professionals to maintain, improve, and broaden their knowledge, skills, and expertise required to achieve their professional goals through webinars, seminars, etc. The program for this evening is as follows. We have got two sessions of 1 hour each, and the topics are UAE transfer pricing, the practical insights. They will be taught by our very own CA Naman Shrimal from Jaipur, IBC and valuation by Sir Rakesh Tulsiar. Our eminent speakers will talk about the above mentioned two emerging areas of professional interest. So now I would like to welcome the Vice Chairman of the CP Committee and the Directex Committee of ICAI, CA Vishnu Kumar Agrawal. He is a Central Council member of ICAI for the term 2025-29. He currently serves as the Vice Chairman of the CP Committee and the Directex Committee of ICAI. Additionally, he is an esteemed member of several other committees of ICAI. With over 2 decades of experience, he specializes in income tax matters and has authored the book Rent Mark Judgments of Income Tax. Social engagement and community involvement of Sir is incredible. He is actively involved in social service and community initiatives. His professional acumen, leadership roles, and dedication to both the profession and society make him a respected figure in the accounting and taxation domain. Now, I would like to welcome Vishnu Agrawal, sir, and request him to take over the session for his speech.
Very good afternoon, and thank you to
मीटिंग चल रही है कोई अर्जेंट कोई
Deepika ji for introducing me. The Honorable Central Council member and the Chairman of the CP Committee, Sri Satish Gupta ji. Today's speaker on the UA transfer pricing, CA Naman Srimal ji, and the valuation, Sri Rakesh Tulsian ji. Naman ji from Jaipur and Rakesh ji from my city, Mumbai, and Naman ji from our CP Committee Chairman, Satish Gupta ji, city.
Sir, are you there?
विष्णु भाई
Yes, sir.
आवाज नहीं आ रहा आपका
Sir, we
मेरी
need
आवाज
your
नहीं आ रही
welcome
है?
address.
अब ठीक है अभी आ रहा है
Okay. Sir, I welcome all my participants in the CP's this webinar. Honorable our Chairman, the CP Committee, Sri Satish Gupta ji. Today's speaker, Sri Namas Srimal ji, and Rakesh Tulsian ji on the valuation. And today's moderator, uh, Deepika Agrawal ji, and our committee secretary, Ajitnath Tiwari ji. I welcome all of you in this today's webinar on the UAE transfer pricing and the valuation. Friends, every Friday from 4 to 6, we host this webinar from benefit of our all the members across the country, and around 2,000 members every Friday take the benefit of this webinar. Friends, today we have chosen the topic on the transfer pricing and the valuation because both of the topic are very hot topic and always expected from members that all the members are eagerly waiting for this particular two topic, valuation and the transfer pricing. Our all young chartered accountants are also doing the practice of the valuation and the transfer pricing. So our chairman has thought that why could not we took a session on the transfer pricing as well as the valuation. Friends, and today we have invited our two of the guests, Srimanji from Jaipur and Tulsianji from Mumbai, for to do all the to for two of the program. And I'm sure all my both of my speaker will crystal clear about the fundamental of the subject. So I will not take much of the time, and I request Deepika ji to introduce our chairman CP committee, and then the CP committee chairman will also address to us.
Thank you
Thank
so
you.
much, Vishnu sir. So I would like to invite our chairman, C.A. Satish Kumar Ji Gupta, for the Central Council member of ICI for the term 25-29. And he is also serving the institute from very large number of period as far as I know. He has been a CCM for the term 2019 and 22 as well. He currently serves as the chairman of the CPE committee and is the chairman of SMP committee of SAFA, a very important community for all of us, the South Asia Federation of Accountants, and CSR committee in the past. He has received several honorary awards such as Excellent Branch Award, Special Silver Guide, Shield Award during chairmanship of Jaipur branch, Best Member of the Year 2004 award. He has written more than 8 papers and has delivered lectures in different seminars, RRCs, webinars on topics like GST provisions, income tax assessments, reassessments under Income Tax Act, etc. Now, may I welcome C.S. Satish Kumar Ji Gupta, the Chairman CPE Committee, to please address the August gathering. Sir, you are mute. Please unmute. Satish sir.
Thanks, Deepika, for such a nice moderation and such a, I think, imaginary introduction. But thank you very much. Thanks a lot. And my vice chairman of the committee, my brother Vishnu Agrawalji from Mumbai, and a dynamic leader, and with whose support we are working a lot in CP committee this year. And team CP and my dear Namansri Malji from Jaipur, is a wonderful friend and a very knowledgeable speaker, practicing international taxation and several other fields, who is going to take today the UAE transfer pricing provisions, a practical insight on those. I think wonderful topic by a wonderful speaker. Another speaker is the Rakesh Tulshanji on IBC valuation. Otherwise, it is also going to be a great topic today. So friends, I also welcome each one of you who are attending this webinar in a very large number, because the topics are really wonderful, great, and we hope that these topics will go a long way to our professional life. I would like to tell something about CP committee, our plans for this year, and you would be happy to know that from this year onwards, we are going to make CP credit on real-time basis, meaning thereby that the member will suppose attends 4 hours out of 12 hours program, he or she will get credit of 4 hours only. So we are just taking the help of technology, and we are going to make it compulsory this year that credit will be allowed only on the real presence, real attendance of the program. We need your suggestions, we need your feedback and implementation whenever it is implemented. But suggestions prior to that, if you suggest this can be the better technology, this can be more effective, this can be more easy to learn, so we would definitely welcome your suggestions. Apart from this, friends, we have taken this year as a making the quality of CP programs. What we are going to do, that we are just making a list calendar for the events, proposed events for every branch or say every CP chapter, every CP circle, and they may take the topics of their choice out of that calendar. Our CP portal also provides you the list of faculties. You can go on the CP portal, you can select the name of faculty of your choice on that given topic, and you can contact him or her for attending your CP programs. So this we have already implemented. So calendar, it will reach to you within 15 days to all the branches. Thereafter, branches will definitely work on that calendar. We are also going to arrange a train the trainer program. I would request each one of you, if you have any interest to deliver on any topic of your interest, please write a mail to CP committee. We would definitely consider your application and would contact you. Our trainers will train you and would definitely give you an opportunity to speak on in our webinars on or in our other CP programs organized by the CP committee or other committees. So friends, with this, I would also like to tell something about the Union committee, which where I'm also chairing that committee as a convener. So friends, I would like to tell you that in the Union also we are going to take 2 or 3 good steps, that we are going to restrict that no member can sign 61st tax audit. He will not be able to get Union out of because of that particular provision we are going to make in the Union system. तो 60 ऑडिट के बाद 61वीं ऑडिट कोई भी मेंबर साइन नहीं कर पाएगा. टैक्स ऑडिट की मैं बात करूं तो लाइकवाइज वी आर आल्सो मेकिंग अरेंजमेंट दैट यू कैन नो द नेम ऑफ सक्सीडिंग ऑडिटर ऑफ योर ऑडिटी who have left you and has gone to another chartered accountant without paying your fees. So you will be able to know the name of succeeding auditor in case of tax audits. Likewise, we are also going to make that if you are as being an auditor, you have to make in UDIN that whether you have qualified the report, whether you have given any EOM, etc., etc. So this is because we are just trying to make the quality first for our members and for our profession for the year under considered under these 2 committees. So I would not take much of your time because both the topics are very important topics and both the speakers are learned speakers, and you would realize after the that particular webinar that yes, you have got some value addition today, and who have not attended this program will definitely miss it out. So thank you very much, sir. Thanks, Naman. Thanks, Tulshan ji, for giving your valuable time, and thank you, my dear members who have attended in such a large number in this webinar. Thanks a lot. Over the Deepika.
Yeah, sir, I'm here.
Okay, thank you.
Thank you so much, sir, for your kind words and giving so many opportunities to the young chartered accountants that they can come over here and share their knowledge over here.
Thank you,
Deepika. Great takeaway from this webinar, and I hope all the active listeners over here will be taking up this opportunity and mailing to serve.
Thank you, Deepika.
Thank you, sir. So without wasting any more minute of any of you, as we have the esteemed Vice Chairman and Chairman spoken about the various incentives given by the ICAI, we will shift over to CA Naman Shrimal. He will be sharing his knowledge on UAE transfer pricing, a practical insight. UAE is one of the hottest destinations we all are looking for as an Indian businessman and professionals. Many of our chartered accountants are well placed over there. So CA Naman Shrimal ji, we all are looking forward to have really great insights from you and how we all can benefit from the UAE transfer pricing with the Indian government. Naman Shrimalji is a seasoned CA who believes in simplifying the complexities of finance and taxation. As the head of cross-border transactions at a firm, he has been instrumental in assisting both multinational corporations and emerging businesses with financial strategies and solutions. His experience spans over a decade with focus on areas like management consultancy, transfer pricing, international taxation, and outbound investment strategy. He has spoken at various national and international conferences organized by ICAI, BCAS, CTC, and other respected forums, sharing practical knowledge with fellow professionals. So now I welcome CA Naman Shrimal to take over the dais and proceed forward with the webinar. Thank you.
Thank you, Deepika ji, for such a warm introduction. It's a pleasure to always speak on ICI platform. Thank you, Satish sir, Chairman of CP Committee, and Vishnu sir, Vice Chairman of the CP Committee, for giving me this opportunity to speak on this topic, which obviously is very, very hot these days. UAE itself being corporate tax being implemented, and people are started to filing returns over there. and transfer pricing being an integral part of it, it's going to be a really, really challenging job. And obviously, when there are challenges, there are as many as opportunities as a chartered accountant over here. So, really, really commendable of the CP committee to think of these topic and to present this to a larger audience. Let me just share my screen and then we can start. Let me know if you're able to see the screen.
Yes.
Okay, great. So the session is all about practical insights. I also want to thank my team member Harshita Dhariwal, who has helped me in preparing this presentation. And the topic, like such, transfer pricing as a whole cannot be completed in the given 60 minutes. So the word has been added, which is a practical insights. So I will focus more on what is my learning of doing transfer pricing in UAE for last 1.5 2 years or so, and how that practical insight could be useful to you. Before that, normally when it's a webinar or something, people are attending. I pose a question with how well versed are you with TP? Unfortunately, I don't think so that because it's a medium where you cannot answer. Still, generally it is to be seen that how many people understand about the TP so that we can take the session in that manner. However, I will take the session on a very basic to a practical insight way so that all of us benefit. Every session has some ground rule, and there are some ground rules over here. Why are we doing this session? TP is an important part of corporate tax practice. Anybody who wants to do something in UAE now has to do something with corporate tax. VAT came, a lot of chartered accountants, Indian chartered accountant benefited out of that. Corporate tax there, and because it's a new thing in Middle East, but we have been subjected to this transfer pricing norms for 24 years and corporate tax for more than 60, 70 years. We are well aware of it. So therefore, to practice corporate tax, you need to understand transfer pricing. What are we going to do? Basic introduction and some practical insights of practicing in UAE. In next 60 minutes, we are going to cover. How are we going to cover? Some law, experience, and some example. I will focus, let's say, at least 20, 30 minutes of our time to give you an actual example of how transfer pricing studies are being conducted in UAE. Interactive obviously is not possible. TP is an art. TP is a mixture of a science and art. There are certain ways of doing things, but there are more uncertain ways of doing things. So there are more ways of doing same thing. And therefore, TP is art. TP is like story writing. TP is like creative writing. TP is like whatever you have discovered, how you can write it in better, how you can express this in a better manner. So TP, in my opinion, is an art. And therefore, there are many ways of doing the same thing. I may tell you some way of doing things. There could be another way of doing things. And let's have fun. Let's learn something. These are the topics which we are going to cover. These are the agendas. Don't get overwhelmed by the number of the agendas. This is a standard PPT, but we'll encapsulate and try to finish by 4:10 p.m. For the 5:10 p.m. something like that, so that we get a great coverage on a practical side. What is transfer pricing? Simply, in a very, very layman language, transfer pricing means that on what price, on what markup you have transferred your products or services. We learn transfer pricing in costing as well. So at what price or what markup you have provided or sold or bought or any transaction done with your related parties. Now, why it is so essential? Let me give you two examples to give you the criticality of transfer pricing in corporate tax world. Simple transaction. A situation, let's say this PQR Limited is there, sale of 120, John Inc., sale of 140, third party. What it does is that, let's say, sales is 120 over there, the profit is 60%, tax at the rate 30%, you pay tax at the rate 18%, 18 rupees. Similarly, John Inc. sold these goods and it pays profit on the tax at 10% of 20 rupees. It is unrelated party, normal party. PQR Limited is not related to John Inc. However, when it becomes an associate enterprise or a related party in UAE terms, what simply can PQR Limited do? PQR Limited can simply say, I will transfer this product to 60 rupees. Okay. Sorry, the profit is zero. There is some mistake in the slides. The profit is zero and therefore no tax to be paid in the country of PQR Limited. However, you would pay a little higher, you will get a higher profitability over in the country of John Inc. and you will pay still, the group will pay less tax. Over here, the group would have paid, just a second. The group would have paid 20 rupees as a tax. Over here, the group will pay 8 rupees as a tax. The group as a totality saved a tax because the transfer price was there in their control. Now, what does transfer pricing law says? Transfer pricing law says, no, this is not accepted. You have to transfer this as 120. What would have been then unrelated party doing such a transaction? Please do the transaction in such a manner. And that is how transfer pricing would work. So UAE has imposed a law. Till there were no corporate tax. No corporate tax, no transfer pricing. There is no tax. Where is there? Whatever you do 60, you do 80, you do 120, doesn't matter to UAE government. Now UAE government wants to tax you at 9% and therefore it wants to ensure that tax base of UAE is intact. It is not being tainted. So this is one of the example. A second example simply be A Limited giving a loan to B Inc. Tax rate is over 30%, tax rate is over 20%. A Limited will actually take, has taken a loan. It will pay its interest on 20% instead of a normal 10%. And therefore, tax base of country of A Limited would be reduced and therefore lesser tax for the group. Simply transfer the related party, the transaction between related party and reduce the tax burden. The transfer pricing officer comes into place. He says that you have to do the transaction at arm's length price. Once you do the transaction at arm's length price, please pay tax fairly at both the places. That is how, in nutshell, transfer pricing is all about. Let's now understand history of transfer pricing. And we see the historical background that transfer pricing was introduced in somewhere in 1950 in UK. Europe, there is a very, very small nations. So, people can easily work from one country to another. As simple as that. And UAE introduced transfer pricing. It's been a long journey. UAE transfer pricing has some peculiarities, which we'll say later. These slides is just for your understanding purposes, that what are the various ways, what are the which law contains. So in UAE, the UAE corporate tax chapter 10 contains the articles related to transfer pricing. So Article 34, Article 35, Article 36 are the major substantive provisions for transfer pricing. Then you have related to transfer pricing documentation, general anti-abuse, intra-deduction, what are the record keeping and transitional rule, what are there. So, but the main focus is on Article 34, 35, 36. So there are various, updates coming by FTA, the Federal Tax Authority of UAE, which is helpful on understanding. And they came out with a very, very wonderful guide. I must say that UAE tax authorities are very, very business friendly. The kind of guide they came out with, the Indian government also does not has taken out that kind of guide. Though ICI has a very, very good guidance note on transfer pricing, ICI has also a very good guidance note on UAE corporate tax, or a book on a UAE corporate tax. That is very good, and we are anticipating the next version of it. Similarly, UAE FTA has given a very good transfer pricing guide. It's a condensed version of OECD. US has adopted OECD rules and regulation, and therefore, if anybody wants to learn UAE transfer pricing, I would say the base would be to get through that UAE FTA guidance, which will be really, really helpful. What are the implications? Those who have worked with UAE companies and everything, they must be aware that before the introduction of VAT, before the introduction of indirect taxes, and now before the introduction of corporate taxes, Dubai entities or UAE entities used to transact in whatever manner, and all of us are aware, in whichever they wish to. Now they can't. Everything is recorded. You have to pay tax on everything. So you have to align your existing pricing and policies. You need to, there is an impact on free zone structure, because remember, and very, very critical point again on UAE corporate tax, your free trade zone structure, which is on a 0% corporate tax, will only get zero through the 0% corporate tax only and only if the transaction it is making is at arm's length. If the transaction is not at arm's length, then again, it will be denied its 0% exemption. And even in free trade zone, you would be end up paying a tax like in a mainland, like a 9% tax. So it's very, very important. So what is the implication? You need to see an impact on existing operating model. You need to see an alignment of existing policies, impact on free trade structure. This is very, very important. And see, you step into any new country, you need to understand its laws. Again, my practical perspective from you, and I was struggling, and I'm still struggling to understand those all free trade zone, Zafza zone, DIFC. But you need to go to Dubai, you need to go to Abu Dhabi, you need to go to Sharjah, and you need to understand what kind of zones, you need to understand those trainings so that you speak that language. As I said, the session today is not just about transfer pricing, it's about practical insight. And practical insight, anybody wants to work into UATP, go there, visit, understand this terminology. What are free trade zone? What are our kind of transactions people having? What are the issues people are having? Then only you will be able to understand and do the UAE transfer pricing. Now, UAE transfer pricing has an interesting term. In India, we use associate enterprise. In UAE, we use related parties and connected persons. The two categories are there, related parties and connected person. Forget associate enterprise for a while. Article 35 says about related party. Any related party who to related to fourth degree of kinship or affiliation. What does fourth degree of kinship and affiliation mean? Like your fourth distant degree relative. This is also from an individual to spouse to child to grandparent to great grandparent to great great grandparent, great niece. All these are related party. So any transaction between these related parties would be subject to, any business transaction would be subject to transfer pricing norms. Now let's come to related party. The second definition, the second limb of related party. And this is very important because this applies to juridical person. Most of the people doing some transaction in UAE would be having some kind of juridical person setup. An LLC and another thing, those companies would be there. Some kind of setup would be there, a branch or whatever. So two or more juridical person are related if directly or indirectly owning 50% or more, along with related party directly or directly control or owns 50% of ownership, or ability to influence 50% of voting rights. So these are also related party. Natural person who is holding 50% or more ownership. So 50% is the criteria, broad criteria, which you need to see. It could be influence, it could be shareholding. Shareholding is deemed influence. Okay. But apart from the shareholding also, there could be influence as well. Permanent establishment, partners in unincorporated partnership, trustee, founder, settler, or beneficiary of trust or foundation, those are also related party. So first set of people which transaction needs to be benchmarked would be related parties. Second set of people would be connected persons. What are the connected persons? Someone who has a ownership, individual as a related party or is related party. Any directorships you hold, director or officer, or any related party director or officer. Partners, other partners in the same partnership, or related party of the partners, these are also connected persons. So a lot wide definition is covered, and you will find that every enterprise who's dealing in UAE is actually dealing with related party and actually has to comply with arm's length. And that's the opportunity, my dear friends. Big opportunity coming up. Anybody who is doing a bit of TP also can foresee a good amount of opportunity. Or let's say you're doing accounting for a UAE TP based firm, or you're accounting for UAE based firms, anything, you can simply get yourself into this transfer pricing mode. Now, what would be the typical transactions that will be under consideration? I'll just have a sip of water and then we'll continue. What will be the typical transaction under consideration? Interestingly, India some while ago abandoned domestic transfer pricing. They said you pay 30% tax over here, you pay 30% tax over here, you pay 25 over here, you pay 25. Not worthwhile doing domestic TP until unless there are some cases of tax arbitrage. Until unless there is an ATIA unit, there is a tax exemption somewhere, then only please do domestic TP. Interestingly, there is a huge tax arbitrage, and again an opportunity for us. There is a huge tax arbitrage in UAE. What is that arbitrage? Individual salary is not taxable. So if the individual does not leave any profit and takes out everything at its salary and does not leave any profit in the corporate and the juridical person, then nothing will be taxed. Smaller entities are not taxed. So if a smaller entity makes invoices of higher amount to a bigger entity, you can literally shift all the profit to the smaller entity, and still you can have 10 those smaller entities and suck out all the profit into bigger entities. And therefore, there is a drastic need of transfer pricing, domestic transfer pricing law in UAE. So there could be domestic TP, related party, let's say sale of machine or payment of machine, machine received or something like that between a free zone mainland and a mainland, something of that sort. There is a domestic TP between connected persons. Even connected persons, simply payment for loan provided. The people, and the important thing is, remember this thing. People earlier never used to take managerial remuneration. A company is mine. I am the only sole owner. Why do I take managerial remuneration? Let me see good hefty profit in company because I will get loans. It will look good. Now because people have to take 9% tax, and remember just 9% tax. Okay. They would say, no, I want my managerial remuneration. Whatever loan I given, I now want to benchmark this and I want to earn on the benchmarking. Why not? And that is how, the domestic TP forms a very big part of the TP assignments in UAE. Then there is a normal international transaction. Anything you have paid, you're purchasing to your related party. As simple as that, you're gonna purchase you're gonna, actually absolutely take the arm's length prices to consideration. So these are the transactions which will be under consideration. A mainland transaction between related party, a mainland free trade zone between a connected persons, individuals, loan, individual interest, and we will see how to benchmark them. I have created an example where most of the transaction would be covered. Hope you will appreciate that example. Now, you understood that in arm's length, you need to come to that very level, whatever the transaction you would have done with the unrelated party. That's the base. Now, how to prove that your transaction with related party is as good as a transaction with unrelated party? You can simply say, how would you say? You can simply say, see, I have sold my goods to my related party at 100 dirham. I am selling the same goods to my unrelated party at 100 dirham. Both I'm selling at same price. Therefore, the transaction, it is arm's length. Similarly, buying from another party, the transaction at arm's length. You can benchmark on a price, or you can benchmark on profit percentage. What you can say, let's say I am a plastic trader. The plastic trader is actually making a margin of 3% gross profit or a net profit margin, 3% net profit margin in UAE. And he would say, find out the other plastic manufacturer who are doing manufacturing or trading, let's say trading for that matter, in UAE, get their margin. If their margin are also nearer to the ratio of 3%, I would believe that the margins are at arm's length. So that is how either you could benchmark on the price or you could benchmark on a profitability. Because once you're proving that your profitability is fine, you're paying good amount of tax or a reasonable amount of tax to UAE FTA. If you're paying the reasonable amount of tax to UAE FTA, then UAE FTA would have to accept it. That is what arm's length principle in general is, in common man parlance. But obviously, it cannot be left open. And therefore, we have arm's length principle, that there should be at arm's length the transaction. Transaction should be at arm's length. And there are certain methods given for those transfer pricing. What are the methods? There are traditional transaction methods and there are transactional profit methods. So as I said, comparable uncontrolled price method. Comparable, I am selling the same pen to my related party at 100 dirham. I am selling the same pen to my unrelated party at 100 dirham. There are a comparable uncontrolled price and therefore my transaction is at arm's length. The resale price, I am buying for my related party and selling. What are the margins I'm making? Gross profit margins. Let me benchmark to the other companies in UAE. And then if I am above that, if I am at a reasonable level nearby that, I am at arm's length. Similarly, cost plus method, you are buying goods from other enterprise, non-related enterprise, and selling to related party. So you apply cost plus method. Transactional net margin method is the most used and at the same time most abused method. We fondly call this in Hindi as Tera na Mera method. If nothing applies, this applies. So transaction net margin method will be a very, very important method to be used in transfer pricing. And there is a transactional profit split method. And we are not going into details again because the topic is not just about transfer pricing and we need to finish it by 5:10 or something like that. So these are the methods worldwide used. There is another method also if you're not fitting into any of these methods, but if by any chance you could prove, that your transaction is at arm's length, please go ahead and prove. Not an issue. Please go ahead. That is an integral part of transfer pricing. Now, for transfer pricing, a very, very important term whenever you do transfer pricing, you will always listen about function, asset, and risk analysis. What is an FAR analysis? What is a function, asset, and risk analysis? See, as I said, you are a trader of a plastic good, anything. Now, is your margin would be same at manufacturer? No. Would your margin be same as a branded plastic manufacturer? Somebody say, oh, I'm buying a pen of a Parker, or a pen of a Montblanc. Would it be same as a pen of a Reynolds? Not really. So, or a pen of a non-branded manufacturer. So your function, asset and risk analysis, and this is where very, very painstaking job, especially in your UAE, because people are not aware of a concept like this. People are not aware of a transfer pricing concept. It's an alien concept. You need to make them aware of it. So your function, asset and risk analysis is of utmost importance. So what does the FAR analysis do? It helps in finding the comparable for benchmarking the transaction. Whatever comparable. So first you need to understand yourself. Am I a trader? Am I a manufacturer? Am I a sole selling trader? Am I a distributor? Am I a low risk distributor? Am I a high risk distributor? Do I carry inventory risk? So these are the various function, asset and risk which needs to be considered while doing a transfer pricing. You need to know, you need to understand the characteristics of your own company to find a comparable. So, and even in a cup method, even a comparable uncontrolled price method, just to give you an analogy of mangoes, a Hafus, an Alfonso mango price cannot be compared with a Safeda, okay, or a Totapuri aam. As simple as that, because these are not comparable. You cannot say, oh, I sold Alfonso at 100 dirham to my related party. I sold the other category of arm, Langda or Totapuri, whatever be it, to my related party at also 100 dirham, and therefore both are at arm's length. No, those are not at all a comparable transactions, and therefore FAR analysis, what is the functions, what are the asset, what are the risk, is very, very important from transfer pricing perspective. Then you characterize yourself. Then you select a tested party. Whose margins are you gonna test? And this I will explain when we do a actual transaction per se. And then you compare. And then you compare those parties. Then you actually do, what are the, comparative in terms of sales turnover. You cannot compare a $2 million company with a $2,000 million company. You cannot compare a new startup company with a old company. You cannot compare a company who does R&D. A R&D company can be a loss making, but it initially would have a really good intangibles to work with. So you cannot compare with that. Your credit risk could be different. So you need to see the factors for determining the comparability. Now, let's sum up what we did and then apply it to the real example, as I said, and that would be really, really helpful. First, identify the related party and connected person. This is a step-by-step guide. Okay. And I think PPTs would be available to registered participants. Identify the related party and connected person. Do a detailed functional analysis. Who am I? Who am I actually? What kind of person I am? What kind of trader I am? What kind of manufacturer I am? Why am I really doing that? From the various method, find out the best method or the most appropriate method. You can use two methods also sometimes to find ALP. Then do a broad base of search. Then do a quantitative analysis that these are the companies I will get selected. I will explain that further while I will show you what are the softwares we use. Then do the qualitative analysis of selection, and then final set of companies would be there. In cup method, this thing would not be there. You will select the company, you will find the comparable uncontrolled price, those transactions, and you will match them up. Okay. Now let's brainstorm with an example. Let's brainstorm with an example. This is a typical thing. So let's say there is this UAE mainland main party, okay, who pays a tax of 9%. It also has a UAE free zone related party at a 0%. It is also has a Indian related party which pays tax at 25%. It has a connected person in UAE. It has a connected person in UAE which would be paying no taxes, which will be paying no taxes. Okay. And it is a third party in US. So what are the transactions going on? Let's understand. UAE mainland, it is paying a key manual remuneration and rent. Okay. Transition 2, UAE mainland is providing software development services to UAE free trade zone. So there are people in UAE mainland who is providing software development services to UAE free trade zone. Then UAE mainland is also purchasing goods from Indian RP and selling it further. Then interest on loan is also paying. Okay. And these are the 5 transactions. UAE third, and UAE actually is selling this to a third party in USA. Then mainland is also paying to free trade zone by some royalty of this royalty income. This we have already seen. So these are the transactions into picture. I wanted to present you a real business case. So how do you, before going into the actual, terms, how do you, and you also think, I do not have a facility of chat discussion over there, but you also think, how would you benchmark these transactions? The most important transaction and most of the UAE transfer pricing would be led by this one important thing: payment of salaries or commission to key managerial person. Payment of salaries to key managerial person. Now, how will you benchmark? Simple way. And why it is difficult? Because anybody can say that this person is worth 1 lakh dirham, or this person is 10 lakh dirham, or this person is 1 million dirham. Nobody knows. How much is somebody's value? Nobody knows. And therefore, such transaction becomes difficult to benchmark. So let's go one by one, each transaction and how we can benchmark it. Transaction 1, rent. In rent, you can go to various sites like Bayut, Makan and those, or can go to various broker who can give you the best possible rate this property would be rented out at, and you can do the transaction on that manner. So various sites you can use, or you can take quotes from various brokers. This is how we are doing these rented benchmarking of this rented transaction. Then payment to key managerial person. A key managerial person, you can prepare a job description, and you can take again various quotes from various HR agency. So let's say you prepare, my chairman come managing director is a 20-year experience in real estate field. He is an MBA from Wharton. He is also, a public speaker, a TEDx speaker, and as a committee of UAE Real Estate Development Council. He's a member over there. Now you float, I want such a person to head my company. Please, HR agencies go and find out what money I need to shell you out to pay such a person. Or vice versa, such a person can get job at what rate. Now, 5 HR agencies you can go to, they will give you quote, match with this quote your remuneration. However, this exercise is not free from misjudgment. FTA can simply say that you have managed those quote, and therefore, while this could be a good secondary way of doing things, I would believe that it best is that you take out the overall profitability of that company after paying key managerial remuneration. And if that profitability after paying key managerial remuneration is also at a higher rate, or rate in that comparative median range, then the transaction is at arm's length. Got it? Because at the end, what is FTA concerned about? It is concerned about the taxes. Taxes is a derivative of profit. Profit is right, tax is right. Profit, if comparable companies' profit is right, then your company profit is also right, and therefore taxes are right, and therefore FTA would be happy. So do take quotes if you want to, but take as a secondary. But KMP remuneration can be benchmarked by a TNN method on overall profitability basis. Software development services, the transaction T2, which was provided by the UAE company to the free trade zone, you find a comparable software company. So you go to software like an S&P Capital IQ or a TP Catalyst, Orbis. This is what it looks like. You run your searches that, okay, S&P Capital IQ, these are the searches, these are product description, these are all these things. And you find out a comparable company. You run out these searches and you find out, okay, these are my comparable. This is Orbis. And you find out that these are my comparable companies. Fortunately, unfortunately, not a lot of UAE based companies would be there, because UAE, there is a scarcity of data. And therefore, you would have to go to EMEA region, you would have to go to Eastern Europe, Northern Africa. Those regions would need to be covered while doing such a transaction. The next one was purchase of goods. Okay. So I mentioned in the facts that the Indian company you are buying goods, the Indian company is also selling goods, or you are also buying goods of same thing from third party. So if there is a good purchase and there are almost the same transaction, same value, please go ahead and benchmark. If there are differences, then can you make them, eliminate them, those differences, and can you change any price in the open market? That would, I think, would be a good way to benchmark these transactions. Interest on loan, Refinitiv Loan Connector is one of the software which can be used. Let's see, in a same way, who pays in a same credit rating, what kind of loan you need, what kind of interest of say needs to be paid. This could be used. Royalty software like Royalty Stat can be used. Therefore, these ways of doing practically is very, very important, and these learning of the software to know how these software work is very, very important. Transfer pricing documentation is, if this revenue is more than 315 $200 million, $200,000 and $3.15 billion, then AED, sorry, then you need to, there is a documentation applicability, both local file and master file needs to be prepared. There is a disclosure form, like in India, a CA sign off in form 3CEB. There is no CA sign off. The person only needs to, fill that form into their income tax return form. 9 months after the end of financial year, they need to tell what data they are using, what are the benchmarking terms, and then needs to be submitted. So I think that is there. Very, very important TP consideration for free trade zone. It's a essential requirement, because free trade zone are taxed at a 0% rate. Something which is taxed at a 0% rate, it's very, very important that a transaction happening with the outside world are at arm's length. If the transactions are not at arm's length, and therefore, it is really very, very difficult. So adequate substance needs to be maintained. It should satisfy the TP requirement, because it's very, why it is important. The moment FTA says that you do not satisfy TP requirement, your 0% status gone. If your 0% status gone, you need to pay tax at 9%, which will be a blow to a free trade zone entity. So these were my practical insights, whatever time available I wanted to convey. Next slide and the next two slides I will end in next 7 to 8 minutes. The next speaker is there. What are my special considerations for UATP? What I've learned, not from transfer pricing only perspective, but from actually implementation of transfer pricing. UAE is still new to corporate tax in TP. One of my first interaction 1.5 years back, I was sitting in a consultant office, and I was explaining, okay, this is arm's length, this is transfer pricing, this is how it goes, and yeah, he said, sir, okay, fine. Half an hour he patiently listened, thanks to him, and then said me, sir, sorry, I don't understand. We don't understand corporate tax over here. Please from the scratch tell us Why is this even required? And till date, I get that question. Please, from scratch, tell us, why is this even required? This is my company or whatever. And if you sit with clients, they will say, this is my company. I want to do transfer in whatever manner. Who are you to stop me? And therefore, this is a very important, challenging way. But obviously, when challenges, there is opportunity as well. Many still see TP as just an alignment formality. Okay, bharna hai na, we need to do this, we'll get this done. Don't go into deep. We need to get this, do this done, get this done. This is also a troublesome thing. You need to make them aware of transfer pricing. You need to give them example of India. India implemented transfer pricing in 2001. Highest number of additions done in corporate tax from 2001, 2006 to 2010, when this case were opened, were of transfer pricing in thousands of crores. You need to give those example that UAE FTA will also do the same thing. Internal data often incomplete or inconsistent. Often incomplete. You will not find one data not matching with another data, related party schedule not there in the various financials. Therefore, it's very difficult to get the data. Be patient. Be very patient. Okay. Getting reliable comparable, I already said. You go to S&P Capital or TP or Orbis or anything, reliable data, very, very difficult to get because those data are not even available. Okay. UAE region is not that transparent, and therefore the data will be hard to compile. Visa structure don't always match up group setup. UAE, this will be common problem. There will be 10 different companies. One company cannot have more than these visas, so they will buy visas at another company. The company will be paid, say, paying salary from somewhere else. All that mash up. They are on the payroll of some other company, but salary is paid by someone else. All intergroup service and all that stuff is there. So that is very, very important. Rather than coming to arm's length, transaction structuring is requirement first. So very, very important. Once you step into doing transfer pricing into UAE, first transaction structuring is very important. No past record of interest and remuneration. No past record, because they were never paying it. They were never charging interest. Why too? Because if you charge interest, some of the time profit would come to zero, especially in large real estate companies. Just current account entries are there. Lot of ground to cover, but yes, good start has been made. I am seeing the traction in last 5-6 months. So if you want to make your mark, this is the time. Travel to UAE, write about it, listen to people doing UATP, learn it, and you can do a there's a huge opportunity, and there are few consultants. It's a very, very good opportunity. My last slide as a tips for TP. Be creative. Do not copy paste. Most of the people ask, "Arey, give me that report." Now we'll just copy paste. No. And this is TP for general. My 15 years of TP experience into one slide. Okay. Be creative. Don't just copy paste. This is also software development. This is also software development. Let's just copy paste, same markup, same everything. No. Understand the world of database. What does S&P Capital IQ does? What does Orbis does? What does Royalty Stat does? What does these things do? And absolutely understand them. Do a lot of trial and error. Do a lot of trial and error. Okay. Stringent qualitative analysis. Is this company really comparable? Is this company doing the same work which I'm doing? It's very, very important. Discussion with only client accountant will not happen. Understand the business. You need to step out of the cabin. Understand the actual business. Step out of the cabin and then do the work. Transaction-wise analysis versus an entity-wise analysis. Remember, transfer pricing is always transaction-wise. Payment to key manager remuneration is a different transaction. Purchase of good is a separate transaction. Interest on a separate transaction. These all will be done as a transaction-wise basis and not on a one-to-one basis. Identify alternative source in public domain. If I want to, then how do I benchmark this transaction some other way? Is there a possibility? Is there some other way? Is there third way? Is there fourth way to do it? Somehow can I prove this is at arm's length? Identify alternate source of information in public domain. Make suitable adjustment, well backed by supporting working. Don't do the adjustment like this. Okay, my company is 5%, the other company is 10%. I will only take 5%, remove 10%. No. Make suitable adjustment, well backed by supporting working. Analyze the importance of market condition. Avoid cherry picking. जो benefit है, which is lower comparable, don't take that. Remove the higher comparable. Do not do that mistake. Document the whole process. Everything needs to be documented with reasons. Why I am taking this company, why I am taking this comparable, why this is important. Everything needs to be documented with the whole process with a reason. And obviously enjoy it. You can only do something if you can enjoy it. If you do not enjoy, you'll not be able to do anything. I love transfer pricing. I've been loving it for last 15 years, and therefore I go into deep, I go into nitty-gritties of it. This was just a small session. I would encourage CP committee to actually do a lot of session related to transfer pricing, Indian transfer pricing, UAE transfer pricing, international tax is an area, and therefore give various members all over India and outside an opportunity to develop this structure. Thank you once again, CP committee. These are my coordinates. You can connect me on LinkedIn. You can also, we have a small group called International Tax Group on WhatsApp. You can connect me over there also. We keep posting various updates on international tax. And thank you once again, the CP committee of ICI, for giving me this opportunity to dwell upon this very, very important yet often neglected topic on UAE transfer pricing. UAE is really a hub spot of activities. Many and I see many people are moving to UAE for providing services. Remember, localization is important. To go there, to spend some time there, just sitting in your city in Mumbai or Aurangabad or Jaipur or Delhi will not work. You need to understand the locals, how colloquial things, what are the various company law, what are the various things, and what are the problems people are facing with, and then only you will be able to actually work on that basis. Okay, the future is bright, the future is immense. There is a lot of work in UAE transfer pricing, and I request you to whoever is attending this session to take a leap ahead and join courses of ICI, BCA, CTC, other forums to understand transfer pricing and to leap ahead into UAE. So thank you so much, Deepika ji. The session is over, and you can take the lead ahead.
Thank you so much, Namanji. It was truly an inspiring journey for the last 1 hour. We all gained insightful experience from whatever you told us, and hopefully, we will be able to organize more rounds like these. And we have few questions for you, which
Sure.
I think you have already covered in your topic. But there's one question if you feel that there can be something else to be added.
Please.
So it is from Sahir Anis from Dubai. He's asking that how hard it would be to get the data of comparable companies in the UAE or Middle East since they do not have any disclosure requirements, unless, of course, it is restricted. How to approach in this situation?
So yes, I have covered that. Very good question and a very, very general question which has been asked. It is next to impossible to get UAE related data. Very few companies even are listed, and these data are compiled by either by exchanges or by data shared by banks. In both cases, UAE data is not available. Even Middle East data is not available. Thankfully, when we do the approach, and I think FTA will also consider that, either you take Orbis or you take any of the S&P Capital IQ or any other software. We use these two. Any of these software, it's like you have to expand your region. So you go to EMEA region, you go to Northern Africa, you also take sometimes APAC region, depending of the kind of companies. You also take sometimes Eastern Europe. These all region needs to be considered, because you will not get UAE centric data per se. And I think this limitation FTA will also know, and they will, when they do audit, they will also accept this, because if data is not available, how do I go forward? The data is not really available for UAE based companies.
Thank you so much, Namanji. It was a wonderful journey, and I hope more than 600 viewers are there with us online right now. They must have enjoyed and really learned and solved their problems which they were coming across. So, moving forward to our next speaker, I would like to invite CA Rakesh Tulsian. Rakesh Tulsian, thank you, Namanji.
Thank you.
Yes.
Thank you, Deepika.
Thank you. As we are lacking time, so I thought let's move over to our next speaker, because he might also require some good amount of time to explain us about the Insolvency and Bankruptcy Act. So here we shift to CA Rakesh Tulsianji. He has handled 19 cases of listed entities, power sector, service sector companies. He is empaneled with most of the major banks and with SEBI as administrator, and is also official liquidator and has rich experience of financial market as professional banker over decade working. Recently, he has handled liquidation cases where recovery was more than twice the liquidation value and many plans approved in NCLT. He has handled various assignments of valuation, cases of IBC, and forensic audits. He is also an author. His book is named by Handbook on Liquidation and Voluntary Liquidation. It has been published by Institute of Chartered Accountants of India. So anybody who is interested in going in-depth knowledge of Setu Rakesh Tulsianji may go forward and see his book. So may I please welcome Rakesh Tulsianji to please take over the session and teach us about the IBC and valuations. Rakesh sir, are you there? Rakesh sir, are you there? Yeah, I am.
Yes, sir. I'm just starting this. One minute. I have stopped my voice. Yeah, so I will start. Considering my voice is audible now. Yeah. So good evening, friends. Today we are discussing the IBC Insolvency and Bankruptcy Code as well as valuation as per Insolvency and Bankruptcy Code. I, Rakesh Tulsian, took the session right now. So what we are going to discuss, basically we are going to discuss the valuation under the IBC Code 2016, which is a crucial element in CIRP, Corporate Insolvency Resolution Process, Liquidation Process, and Voluntary Liquidation Process. All the three, you will find it out that valuation is very important, and how we get it, we are going to see in the coming slides. So what are the applicable provisions? So section 18 of IBC code, section 25, which talks about the duty of the RP, that he have to take the valuation from the two valuers. So that is the duty of the RP. That is also applicable on this. Then IM, information memorandum, when the RP will prepare the information memorandum, at that time he needs evaluation. Section 32, when the RP examine the resolution plan, he have to put the resolution plan after evaluating, after checking all the mandatory requirement under IBC, and put it before the COC to discuss with the resolution applicant if required, or they will take the informed decision about whatever the things are available in the resolution plan. Then there is a custody of asset in liquidation. So these are where we require valuations in IBC. So these are the applicable provisions under which we require a valuation under IBC. Then there are CRP regulations uh, under which we have to get the valuation done. Then there are uh, regulation 27, which talks about the appointment of registered valuer. The regulations are given in the CRP regulations. We are talking about the CRP regulations right now. And the regulation 35(1) says that the RP should get the fair value and liquidation value uh, of the company. Then there are company registered value and valuation rules 2017, and there are numerous circulars and notifications issued by the IBBI which affect the valuation during the period of insolvency, bankruptcy, liquidation, CIRP, or you can say voluntary liquidation. In all the places, you need to get the valuation done. Now, so what is the fair value? Fair value is all about the estimating the realizable value of the assets between the two valuing parties. It's called a fair value. I will just give you example like a water. So what is the price of the water? If we ask frankly, we will say 20 rupees a bottle, which is a 1 liter bottle. But what is the value of the water is depend on the how thirsty you are. So fair value in the case of assets, we have to estimate the realizable value. What is the realizable value of the item with the two willing party, and they are transferring between the at arm's length. Then there is a liquidation value. So that is the realizable value if the corporate debtor, which is a company for which the insolvency process has been started, were to be liquidated on the as on the valuation date. So valuation date will be CIRP date. So when suppose a company went into the liquidation or under CIRP as on date of 5th of January 2025, then the valuation will be get done on 31st on 5th of January 2025. So valuation to determine in IBC case, the two value which we have to determine, one is fair value, one is liquidation value. The two value, the valuers, right, registered valuer have to give to the RP, who appoints them according to the provisions which we are going to see in future slides. Uh, so when the RP appoints valuers to do the valuation for the company which is under insolvency or liquidation or voluntary liquidation, at that time the valuer have to give the fair value as well as the liquidation value. So what are the process in IBC and what are the timelines? So two registered valuer will we get for the each class of asset. So there are three class of assets prescribed. One is land and building, another one is plant and machinery, and third one is security and financial assets. So you have to divide all the assets of the company into the three part, and in that you have to get the valuation done through the registered valuer under that category. So someone have asked, what about the uh, intangible assets? Intangible assets, because it doesn't come under land and building, it doesn't come under plant and machinery, it will come under SFA. So the SFA valuer have to do the valuation. So we have to appoint, the RP have to appoint two valuers in each class within 7 days of its appointment. So as we know that the first 30 days in any CRP will be the insolvency professional known as IRP, interim resolution professional, and in the first COC meeting, creators committee of creators meeting, they recommend the name of the RP, and then RP appointment application need to be filed before the NCLT, and NCLT approve the name of the RP, and then RP will get charged. As per IBC is concerned, IBC says that within 7 days of appointment of RP, the two valuers need to be appointed. And as well as it also says that if by the 14th day, if the order for the order of the NCLT doesn't come for appointment of RP, in that case, from that day, from 40 day onward, within 7 days, the RPs, the valuers should be get appointed. So 47 day, effectively, the valuers should get appointed. Valuation generally based on and how the valuation is done on the basis of DCF, discounting cash flow method for the going concern company. How the DCF will get calculated, we are going to discuss in the next future slides. Then there is a NAV, net asset value methods, or market comparable methods, where non-operational units are there. And once you get the valuation from the valuer, you have to take average of the two valuers report. And if there is a significant divergence, means within the valuation given by one valuer in that category is different, and the difference is more than 25%, then you have to appoint a third valuer with your COC approval, that to get the average value. And in that case, you have to take the average of all the three. So this is the process by which you have to get the valuation done. And how and what is the use the valuation report by the RP. So the RP use the valuation report at the time of evaluation of valuation plan. Valuation plan, as per Regulation 39, the COC considered valuation plan based on the valuation reports. They take an informed decision about the value which is offered to them by the valuation applicant in the valuation plan, and but that is just giving them a guiding value by which they will take an informed decision. In the case of liquidation, for the distribution under Section 53, so valuation will support the stakeholder distribution, how much the value and how we are going to get the auction done for assets of the company which is under liquidation. So simplified, when we are going to explain it, under IBC, when a company goes into the liquidation, we need to get the two certified valuer to check what the company is worth of, what is their fair value, what is their liquidation value, and they estimate, and the valuer will get estimate the fair value when the normal, if the company is in normal dealing, then liquidation value if the company is being to be sold as at a distress value. And this value helps lender and creditors to decide whether to approve the valuation plan or to go for a liquidation. They will take an informed decision based on the valuation which came, which came through the valuation professional, and which has been done by the registered valuer. Registered valuer means valuers who have requisite qualification and who are impaneled with the IBVI as a registered valuer in that category. In that category means three categories which we have already discussed: land and building, plant and machinery, and security and financial assets. Securities and financial assets. So the three asset class, the list of the valuers, you can get it through the IBVI website also, where the IBVI provides in their service category, service provider category. Nowadays, registered valuer can be a registered valuer entity also, and if the valuer, the two valuers gives a report which is an independent report by the valuers, and if there is a very vast difference between this the two valuer, Then the third expert, valuer experts, will be called to share their report, and then the decision will be taken care. Recently, the for the saving of the cost, the in some of the cases, the valuers will get appointed. Only one valuer get appointed. So practical checklist. So you have to collect the information from the CD, from different sources. Basically, all most of the information come from either you take it from the MCA website, either you take it from the management, to through the bankers, to anywhere from wherever you find the information. This is the responsibility of there's a professional to collect the entity information, like about the financials, what is the amount shown in the financials of the corporate data, as well as the asset register, what are the assets lying, where it is lying, and in what conditions they are lying, what are the liabilities, what are the projections has been given, if it is a going concern, the company is undergoing concern, at what operational level it is working on. So that will help the valuer to get the proper fair value, so that the decisions will be taken uh, based on the valuation report. Now, second, uh, when we have get appointed, when we get appoint the registered valuer, they have to give their reports, right? So, how many days they need to take? Generally, it takes 7 to 10 days or 15 days max, and you have to constantly follow up with the valuer to get the valuation report done by providing them data which they require. Because most of the time in the company which is under CIRP, the data are not in the proper format, not full information are available. Then at that time, you have to get the valuer visited the place or the location, and to get whatever maximum information you can get it. Uh, the maximum time the problem comes for the SFA, security and financial assets, where the debtors, stocks, current assets are lying, and you are not sure about what are the data behind that numbers which is shown in the financial statement. So you should have books of accounts, and through books of accounts, and then you come to know through the inquiry or the list which is given by the corporate debtor or the suspended management. So you have to collect the information early, and on that basis you have to get the valuation done through the proper registered valuer who are registered with the IBBI. Then once you get the valuation report from the registered valuer, what you will do with that? Now, first thing, when you call for a draft report or when you are calling a final report, you have to check the methodology. What methodology he used to take, he used to get the valuation done. So you have to check the basis and assumptions. What are the assumptions taken by the valuer, and what are the divergence if the policy of the company or your understanding, and if there is a vast divergence between the two valuers reports and their methodology, you can ask them and try to reduce the anomalies in the two valuers report if you can. Otherwise, you have to appoint the third valuer. You can't influence the valuers, but you should apply your own brain, and you should apply uh, the assumptions which has been taken by the valuer to value your corporate data. Because now you are responsible officer to get the valuation, get it done. Tomorrow the suspended directors or anyone else will raise a finger that why this type of large variations took place. But why? Because once your resolution plan is get approved in the NCLT, it's become a public document. So when the litigation get started, the suspender will ask, definitely check the what are the why the value has been given low or high or different than what they are think for. So to reduce that, you have to check the assumptions and check the basis on which the valuers have given their reports, and you can get it convinced that what is the value which arrived is you are okay with that, even though you are not as a RB as a RP valuation professional, you are not subject expert of the valuation, but still you wherever you find a big value differences, like suppose I'm giving you one example, like for the land and building, if you know that in that area the market price is going on suppose 1,000 rupees, and the valuation you got at 200 rupees, why there is such a large value differences? Then if you ask the question to the valuer, then they will give you what are the reasons for the giving their value at 200 rupees or 2000 rupees, whatever it is. So that will increase your knowledge also. That will increase your when you are going into the COC meeting, you are well prepared, and you can uh, tell to the your COC member or creators that these are the reasons. And again, the COC is empowered to call the valuers to explain what are the methodology, what are the value, and how they are arrived the value. Because most of the time, the valuation done by the bankers at the time of sanctioning the loan or the thereafter are significantly differ with the valuation given by the registered valuer under IBC. And why this happened? Because of the market scenario, because of the situations at that time when there was a uh, happy days of the company. Then what is the use of the evaluation report? As we have already discussed, to plan the evaluation, the lesson plan evaluation, then the comparison, then the liquidation, to making the liquidation strategy, whether the company should take into the liquidation, the value given by the reason applicants are very low as compared to the valuation available for the company, or what are the difference, and that will help the COC member to decide which RA, there's an applicant, they select based on the information which is available with them. Uh, One point over here is when you are sharing the data of the valuation report with the COC member who are going to take decisions, informed decisions on the lesson plan, you first take the non-disclosure agreement (NDA) get signed by the COC member. You can also share these reports on some circumstances with the suspended management, but that also you share it with after taking the non-disclosure agreement signed by the suspended management. So you have to share the valuation report with the COC and suspended management after taking NDA. And this valuation report you should not share with the valuation applicant, because once they know the value, what the value of liquidation value or the fair value, they will try to reduce their offering for the company. And then if the divergence is more than 25%, then you have to appoint a third valuer. So these are the practical checklist for the valuation professional while doing valuation for the IBC matters. So what are the valuation methodology which is used in IBC, both formally and practically? Uh, and why the methodology are very important? Because of the selecting the right method. The full focus is to selecting the right method, which is depending on the nature of the corporate. See, suppose the company is in retail business, what type of methods you are going to use? If the company is in a big manufacturing concern, what type of method, valuation method you have to apply to use? If it is a listed, if it is unlisted, whether it's the public company. So what type of method the valuer have used to value the company is very important. Whether it's a going concern, whether it's a running company, whether it's a closed company, all these things, the based on the situation to situation, uh, the valuer decide the right methodology, which RP should also be aware of. Now, when the companies get valued by the registered valuer, then methodology will give them a chart or a pathway by which they decide the 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 value of the company and assign the value of the assets of the company. As per Regulation 35 of CRP regulations, which says, and the company's registered value and valuation rules 2017, as well as ICI valuation standards and IBC valuation guidelines, they are the valuation approach or valuation methodology used by most of the registered valuer. One is asset-based approach. Second is income approach. Third one, which is used many times, is market approach. And fourth one is other approach in the special cases. So now we are going to discuss all these four methodology or approaches uh, used by registered valuer for valuation of the corporate data. So when you are going to use the asset-based approach, it is used by the company when the company have a substantial tangible assets and very little earning capacity. It is a earning at a 20-30% of this of its uh, peak situation, peak capacity. So at that time, and the company has a substantial tangible asset. At that time, the net asset value or the asset-based approach is used. In that, what the valuer is going to do is they are doing the total assets minus liability, which is adjusted for the fair market value. Either they use the NAV method or either they use the replacement cost basis. So if the assets are being replaced at the current market rate. When it is used, real estate, manufacturing with a heavy assets profile like power sector or hydro projects like this way, dormant company or non-operational company where there is no income approach can be used and that will not be useful. So in that case, asset-based approach, when the value lies primarily in the company assets, then the net asset value is get used for valuation of the company. So they adjusted for the market value for the fixed assets and investments, common for the asset heavy or loss making entities. And replacement cost when cost to liquidate the asset today, and common for the value of insurance claim or replacing based balance. So these are the asset based approach which is used for finding the fair value of the company or the liquidation value of the company. The income approach, in that case, suppose the company is running and the CD is running and it is working, and the company is also making some profit or loss in the current year, and you have some data available for the last 2-3 years, then in that case you can use the valuer can use the income approach also, where the future earnings are predictable. If the after the resolution plan or something, the income approach, the income will be get generated by the company, and they use the key inputs, future cash inflow, terminal value, and discount rates, which is the average weighted average cost of capital. And when the going concern business with the steady revenue services like service sector, tech startup with the earning visibilities are there, which is gone bad because of the current situation, but they have a still capacity to run profitability due to the suppose management is not up to the mark. In that case, the income approach can be used by the registered banker. So when earning capacity is the key, then discounted cash flow is the formula is given. That cash flow should be divided by 1 plus R on the power T plus terminal value of the fixed assets, which is non-operating, non non operating assets. So it involves the future projections and discounting to the present value for startups, tech firms, and going concern. It is useful. Now, when we are saying this, the question may arise that why we are using the income approach when their company is in a bad situation. The company may be bad situation for the many reasons. Maybe the COVID time, at that COVID time, the operations were very shut down, and due to the heavy interest cost, the company is under insolvency. So, and or the promoters who are using that are not up to the mark by as required by the market. So in that case, the income approach may be used. Capitalization of funding method. This is the fourth method by which future maintainable profit are divided by the capitalization rate. When the stable earnings are there, but cash flow forecasting is different, in that case, capitalization of funding method can be used. So market approach, when two comparable companies are available, suppose one company has gone bad, in that case, the comparable company multiple can be used. Valuation is EV divided by EBIT. EBITDA is the formula for the listed peers. Comparable transaction method based on the sales volume in the same similar merger and acquisition, and like publicly comparable companies available like retail, logistic, and tech platform peer methods. In that case, market approach can be used. Comparable company method, multiple methods by like suppose it's a listed company, then you can have a comparable available. In that case, you can use the market comparable companies multiple method. Comparable transaction methods benchmark against the recent merger and acquisition deal, uh, and you find that your company is in such a position by which the competitors are ready to take in their own booty. So in that case, comparable transaction methods you can use. Quoted market price method for the listed company if it is a listed company. But in this market approach, there are a lot of problems in IBC. But as compared to normal valuation, this is also used for the quoted market price, because in when the company goes into the liquidation or in the CIRP, at that time the market price of the shares of listed company goes at the minimum price, maybe 2 rupees, 3 rupees. At that time, the price when the reserve plan comes, the valuer can use this method to say, okay, this is the market price which the market is thinking of this value of this company. The other methods, in a special case, some of the part method, liquidation value method, and adjusted book value methods that can also be used in the special cases. So, when which method is best? So, if the company owns lot of assets, then asset-based method. When it's having earning capabilities, in that case, the income-based approach can be used, or the or if any others you think that it's worth to value on a market value method, then it's a market based approach can be used. So like a tech startup, so there are many companies, because IBC currently, if you see, uh, the earlier problem of the company goes into the bad situation, or the company went into the insolvency, is due to some of the reasons like heavy interest cost, uh, fraudulent promoters, or the market conditions. But when the act was made, when the code was uh, implemented, the thought was that when the uh, new generation will start the business, how early they can exit from the business if they find that the business is not working for them. So take a typical example. One of the student of the IIT or IIM who established one business, and it was giving some profit, maybe suppose uh, 1 crore rupees a year, and after some time, due to some market situation, he got a one good offer of the another company in the US, where he gets 10 crore rupees a year. And he find that, okay, instead of being an entrepreneur, he is ready to get the job at US, and he want to go out, and uh, there are some problems over here which he is facing because of the he is new in the business. He is not able to keep the scope of the interest pressures, or the sales is not as uh, much as it should be. Then in that case, some creditors have took them into the insolvency, or the company can themselves took the CIRP process initiated under section 10 of IBC. In that case, the valuation which is get to be done through the income approach by the valuer, because at that time the company was earning and you have a space. So approaches which is simplified for the valuers, like NAV message, when we are going to use which method, we have tried to cover this in the slides. So the suggested methods which we are going to have, which will be the best method. So in asset heavy but non-operation, we will use the net asset value method. The assets which is available, listed or peer comparable, then market approach is there. Compliance and documentation checklist. So you have to check whether you have at least two methods and reason for rejecting for the others. If the two valuers are using the two different methods, so why they are using this method, not that method, and document and disclose all assumptions. If you are using the DCF method, then you should disclose all assumptions like growth rate, discount rate, margins, and you have to use the constant and reasonable projections aligned with the IBA circulars. Provide reconciliations with the financial statement. What are the assets showing under the financial statement, and what are the assets which you have physically verified. You have to reconcile that too, and whatever assets are missing, you have to just say that these assets are missing and you are not able to give the value of that item. So which will help you to that no asset will get left for get valuation. So you mentioned and it is the contingent liability and now balance sheet item. So draft valuation report, which generally we get first page, it should be having a title page which should have a name of the competitor, and it should be say that report is under regulation 35 of CRP regulations. Then they should give the date of the valuation report, which should be date of valuation date is should be the CRP date or the liquidation date, and valuation signing date may be different. Name of the register value of the name and registration number of the valuer. This is very important. The register valuer should give their mention their register number, and then valuation date, cutoff date when he is doing the valuation. Declaration and confidentiality. The registered valuer should declare the independence and objectivity of the valuation. So he should give the confidentiality undertaking, which should be uploaded on the website of the triple IPI by the registered uh, given by the registered valuer, and it should be reported by the valuation professional. Conflict of interest statement. If there is a conflict of interest, he should report to the valuation professional. And generally, in the case of conflict, the valuation professional doesn't appoint the particular registered valuer. Then he should give executive summary. What is the purpose of the valuation? Brief of methodology which he used. What are the value of the fair value, regression value in a summary? So not in a item by item detail, on a executive summary, and the valuation name of the valuer and the engagement date when it will get engaged by the registered professional. So this executive summary one page report will give a bird eye view to the COC members. So he should give that. And the fourth, which you have to give the brief of the business operations, name of the corporate, legal structure and ownership of the company, key finances of whatever data is available with them, and then current insolvency status and appointment by the IRP or RP. He will say that what is the current status, the company is under CRP and appointed by the IRP or this date by the this his appointment letter. Then he should give a brief of his appointment letter, extent of reliance of the information provided by the RP or the suspended management or the corporator, and he should also place the limitations and disclaimers. What are the limitations on his work, and then he should also uh, put pictures or the details of the site visited or assets inspected or conducted by his or his team. This is also help him to say that he has done his work very diligently if there any assignments come to him. Then checklist for professionals. So you have to select 2 or 3 matters and justify rejections of others. You have to say why this method is not applicable on this company. You have to the valuer will say in his report, and use at least one method for each relevant approach. Documents which is required. What are the documents you have relied upon? Then what are the assumptions you have made? The source of data, which is in basic source like audited financial statements or projections or market data, or from wherever he got the data, he put the data and he put a justification for the input. Why he have selected this? Why? Suppose I have selected the cost of capital at 10%. Why 10%? Why not 8% or why not 12%? You should be very clear and justify the inputs. Valuation reports, valuation results, or the whatever results it is coming out, he should validate with a cross-check analysis whether it is correct or not. Then he should put a description of the assets and liability, tangible assets, what are the land, building, plant, machinery, or intangible, goodwill, patents, financial assets, investment, receivables, secured, unsecured liabilities. All these things he have to look at once the travelers of the corporate data, and he should give the value of all the items which is seen, verified, and valued by him. Uh, Generally, in valuation methodology approaches, he explained the income approach, asset approach, or market approach, and why he select or reject that approach is given in the report. So assumption and inputs also like terminal value, comparable companies, discount rates, all these things are also given in the valuation reports. So computation of valuation values. So he will put the fair value calculation, detailed working, as well as he will give the liquidation value computation. The two value he have to give for each of the assets which he is going to value, and what are the adjustments he has made while giving the value. The summary, and again at the last, we have to give the summary of the both the value. What are the book value? What is the book value uh, as per the books of the accounts? What are the fair value, and what is the uh, liquidation value of the assets? Supporting documents: if he has visited the location, he have to attach the site visit reports and any third party reports if we have relied upon, like technical or legal reports. Suppose in the case of stock, uh, he, where he is of chemical, he is not a technical expert. The SFA valuer is not a technical expert of the chemicals. So in that case, he can use the reports of the technical experts, and he put his report, and he mentioned in the report that he has relied upon the report of the technical person. So conclusion, the final valuation as on valuation date. So he have to give the fair value like X crores, liquidation value Y crores, and a statement showing that these values are averages if multiple values are involved, and it should be signed, seen, registration number, and date or place should be mentioned in the valuation report. So by this, the valuation report given in the IBC report by the under IBC by the valuers. So thank you. I tried to cover in a very short manner the valuations under IBC, and as you are aware that valuer are because this is a recently started in 2016. The IBC is very recently a new code which is young We are now just 8 to 9 years has been passed, and 8 to 9 years it is also evolving over the time. And again, valuation is a subject which was earlier used to do by the uh, chartered accountants and the person who are not very expert in that area. Now, after IBBA came into the picture, or the registered valuer exams are being conducted, which required the professionals with the requisite qualifications. They have to go through the exams, they have to pass the registered valuer exams conducted by conducted online, and then they have to go for 50 hours training also. And again, there is a requirement of CPE hours for the valuers, which help them to keep it updated knowledge to do the valuation. So nowadays valuations are more or less a settled subject, and it is also evolving. Again, when we are saying this, the valuation is very subjective. It is depend on person to person, valuer to valuer, and the value which comes from me may be different the value which you arrive. So with this, I thank the CP committee to give me a opportunity to present my presentation before you. So
Thank you, Rakesh Tulsianji. It was a really insightful session, and we couldn't thank you enough. Am I audible?
yes, yes, very well. So, any questions on this valuations or IBC? I am ready to take. Otherwise, I have tried to cover whatever is not written in my slides also, and to give a bird eye view, because this is a very technical subject. Valuation itself is a very technical subject, and with combining it with the IBC, it is really good opportunity for chartered accountant to be a registered valuer. Thank you, everyone. Yeah. Yeah, I think it's over. So we can close now. Thank you, Akshat.